Today, we are going to do a comparison, Home Depot versus Lowe's. I have my personal favorite, Paul has his, and they're not the same. I prefer Home Depot, Paul likes Lowe's. We're going to walk through the store, we're going to see what's up, and we are going to do a stock analysis and put a value on the price that we should pay for each company. Here we go.
2 reasons why I like shopping at Lowe's over Home Depot. 1, customer service. When I'm at Lowe's, people are coming up to me saying, hey, how can I help you? At Home Depot, it's almost like you're looking at down an aisle, a worker sees you and they turn around and walk the other way. Second reason is better selection. Maybe it's a bias of mine, but I remember back when I was doing some remodels for our apartments, I always found it easier to buy from Lowe's in terms of looking at more options and getting more ideas for us and tile selections and lighting selections especially. So I'm sure there's a bias involved in there. I'm sure Home Depot has plenty of selection, but it just felt like to me, Lowe's, maybe it was part of the customer service, whatever it was, when I need help on something, I go to Lowe's. When I just want to go in and out, the Home Depot is closer to me, I just go to Home Depot.
The Home Depot. It's one of my favorite stores. It's one of those stores that you can go into and just kill a bunch of time. With that though, comes you're gonna buy something. I don't call myself the most handy person, but there is always something that I buy at Home Depot. Another one of my favorite things is how knowledgeable the staff is. And I don't think this just goes for Home Depot, but it also goes for Lowe's. You ask any one of their staff members where something is, without thinking, they tell you what aisle it's down and how far down the aisle. It's absolutely incredible. When it really comes down to it, everybody has their favorites. Some prefer Home Depot, some prefer Lowe's, and usually have everything that you need, whether you are the individual or the contractor.
All right, thanks, Mo. Appreciate it. So guys, let's now analyze Lowe's and Home Depot and compare them. Ironically, I prefer Lowe's, Mo prefers Home Depot.
Yeah.
But you've got to remember, our preferences are not going to drive our investment decisions. If Home Depot is a good buy, I'm going to buy Home Depot over Lowe's. If they're both a good buy, I don't mind buying both. But the point is, we're not going to let our personal bias about the business make us go purchase the company's stock, because the company and the stock are very, very different things. And that's super important for an investor to understand. Once you understand that, you're a step closer to being an investor. It might actually make you an investor. So guys, if you're new to the channel, we're Mo and Paul. We're value investors. We look at every investment as the present value of all future cash flow. And we know that buying a stock means we're buying a piece of a business. So if we can pay a reasonable price for them, the business fundamentals will take over from there. That is our goal as value investors. We want lower prices. We want to teach people a process, not a way of copying us. We want a process that speaks to you, that will allow you to make great investments. And most importantly, as the stock price falls, you look at it as an opportunity, not a point of fear. Because the more you know, the more you understand, the less you will fear, especially when it comes to investing. Now, let's pull up Home Depot, the Home Dizzle. The Home Dizzle, my nizzle. All right. $300 billion market cap, $150 billion in revenue. Current 12-month PE of 19, 5-year PE of 20. Very consistent profit margin over the last 5 years. Last year, 10.6. Last 5 years, 10.5. Dividend, big dividend, guys. 2.6%. Eats up about $8 billion of their free cash flow. Guys, last year they did $12.5 billion. 5-year average is 13. So it's over 50% of their free cash flow. Might be okay. Might be okay because they generate so much. What's their growth potential? But look at this ROIC. They get a really, really good return on the money that's invested in the business.
Wow.
This is a great driver to show moat status. High moat status. This means that they can invest money in the business and get a very high rate of return. How does Home Depot do that? New locations. Now, obviously, they have a lot of locations right now. So expanding into other countries and also into growing markets in the US will probably be a big part of their future. All right. So let's take a look at their 8 pillars real quick. Oh, wow. I'm actually surprised by this. Look at that. Now, remember, guys, if you're part of our software, you can customize your 8 pillars. You can put up to 12 pillars in there, and there's 4 quadrillion different variations. But for right now, I'm sticking with this. The only X is the price to free cash flow. So if you look, their net income last year was 15.9, but their free cash flow was 12.5. So that's a little bit of a difference here. Now, this is factoring the 5 years. So I'm going to go see why their free cash flow is lower than their earnings. Their average free cash flow was $13 billion in the last 5 years, and their average income on the income statement was $14.5 billion. So it's close. You know, a lot of value investors want to see 80% of earnings converted into free cash flow, so it's above that. I don't know what the right number is, but this is pretty interesting. Mo, do you have any comments about this?
No, I mean, this is either Lowe's or Home Depot is one of the companies that I do want to own. I don't know which one it's going to be, but I like the fact that they're both kind of running that duopoly. They're the only games in town. You know, when it comes to that. Ace
even,
Hardware, you have your mom and pops.
Can I tell you something? Menards.
You have your Menards, but
I live about 2 miles from Ace Hardware, and I live about 7 miles from a Home Depot and Lowe's.
You go to Home Depot?
I go to Home Depot and Lowe's.
Yeah.
Lisa will say to me, like, Paul, go to the Ace Hardware. I'm like, I don't want to go there.
Yeah.
I literally want to go to the Home Depot or Lowe's. You know, when I get my tool belts and my sanders and my Phillips screwdriver to build my car.
Your welding material.
My welding
that
material.
you weren't told you needed.
I'll just have the guy charge me. All right, let's see what analysts are saying about Home Depot. Earnings per share this year coming in at $17 was supposed to be estimated, and it dipping and then coming back up to $21 in 2028. And revenue dipping a little bit and going up to $183 billion in the next 5 years. Guys, Wednesday, June 28th, 1 p.m. Eastern time, free webinar on real estate. Our channel loves real estate. We just haven't made many videos on it. We're trying to restart that now. We have a great real estate calculator on our software. Free webinar. Sign up at the link below. Super easy. You're going to love it. Thanks very much. Don't forget to sign up. Let's look at Lowe's first before we do our stock analyzer tool.
Wow.
Ooh, profit margin way lower than Home Depot. Look at this, Mo. Same gross margin, 33.8 versus 33.2, and their 5-year profit margin 6.3 versus Home Depot's 10.5. Now, I will tell you, the customer service at Lowe's I think is better. That might be eating up a big chunk of this. Man, $128 billion market cap. Their free cash flow is a lot lower. Revenue is a lot lower,
Their
though.
ROIC is very comparable.
Look at this PE, 36, and yeah, it's a lot higher.
It is.
Very high ROIC, just like Home Depot.
Let's see.
So from the initial look of it, Lowe's seems a lot more expensive. I mean, look at this PE
does.
versus 5-year PE.
Yep, it does. I'm just going. I have 2 screens up. I'm just going back and forth comparing, and
The 5-year PE isn't much. It's only like 15% higher on Lowe's than Home Depot. Let's see what their 8 pillars look like. All right.
Okay.
Not as bad as I thought it was going to be.
No, I thought it would be much worse. I thought both would be worse, to be honest with you. Let's see
Okay.
what analysts say about them.
Much bigger growth
More
potential.
growth, but they're smaller.
How many stores does Lowe's have versus Home Depot?
Let's see.
So Lowe's has 1,969 stores.
Oh, it says it there. Perfect.
And Home Depot has 2,300. Oh, not that different. That's interesting.
Oof. There's like barely any revenue growth over the next 5 years.
Oh boy, Home Depot is feeling a lot better. The power of the Home Depot. So Mo,
On the
2,000
revenue side.
stores versus 2,300, 91 billion in revenue versus 150. So 15% more stores getting 60% more revenue.
Yeah. Now, Lowe's is the place where more contractors go, less of the
Really?
daily consumer. Yeah,
Really?
Yeah. Home Depot is definitely more of the daily consumer.
I don't like this gross margin being the same and their bottom line margin being way different.
So, based on glance right now, first glance, I'm leaning towards Home Depot. Only thing that worries me about Home Depot is if you look at their revenue from 2018 to 19 was $5 billion increase. Then there was a $15 billion increase into 2020. 2020 to 2021, $23 billion.
Well, yeah,
And
yeah.
It's because of COVID.
Yeah, it's because
It's stabilizing. It's decreasing, but it's stabilizing. That's the only thing I'm going to have to think
All right.
about when I go into my stock analyzer.
Let's go to the Stock Analyzer tool. Guys,
right.
Stock Analyzer tool, #1 part of our website. 1.3 million times it was used in 2022 by our users. This, along with all of our tools, are available at everythingmoney.com for $1 per day. $1 per day gets you all of this. No brainer. Check it out. $7 for 7 days. Try it out. Home Depot, not HomeDepot.com, everythingmoney.com. So, are we going to do these together, or do you want to do each of these separately?
Let's do that. You want me to do one and you do one?
Yeah, you do Home Depot, I'll do Lowe's.
All right.
So we're going to do our Stock Analyzer tool. We're going to do a 10-year analysis. Okay, let's see here. Whoa, increasing ROIC for, wow, interesting. Okay, interesting. So what we're trying to do here is make these wide assumptions, low, middle, and high. The further we go out in time, the wider those numbers are. But our goal is to find companies that are selling for a price that makes sense to us based on these assumptions, okay? Desired return is the We're going to put all these assumptions in. Desired returns are basically our margin of safety. So let's sit here and hit the analyze button.
I'm revising something.
Lowe's company. I'm going to go through it before Mo does.
Okay.
I'm doing revenue growth of 3, 5, and 7% over the next 10 years, my low, middle, and high. Profit margin of 5, 6, and 7 on Lowe's. Free cash flow margin of 6, 7, and 8. PE of 15, 17.5, and 20. So at the end of 10 years, what do I think the multiple for the company should be? Price of free cash flow, I did the exact same thing. Now for my desired return, I did 10%, 12%, and 14. So even though 10% might be low, these are very low assumptions for the company. So I don't mind being more conservative, being more giving on my desired return. I don't need as much margin of safety if I'm making a much lower assumptions here. I already put margin of safety in my assumptions.
Right.
Mo, what were yours?
Okay, so for revenue growth, I did 3.5%, 5.5%, and 7.5%.
Okay.
Profit margin 8.5%, 9.5%, 10.5%. Free cash flow margin 7,
I think that's
8,
too
9.
low.
Too low. So I actually moved it. I moved it down. I did 9.5%, 10.5%, then 11.5%, and I thought 11.5% was a little bit much. That's why I did that.
I think 8.5 is just too low.
Did you think 11.5 is too high?
Yes.
Okay, that's where I was stuck.
So what about 9, 9.75, and 10.5?
Okay, 9, 9.75, and 10.5.
Where it was before.
Okay. All right.
Okay.
What do you think about here? Free cash flow margin.
I mean, to me, I look at that going 8's probably the lowest. Maybe 7.5,
Okay.
8.5, and 9.5.
Okay. All right, let's try it. And then my PE and price to free cash flow, 15, 17, 19, 10, 12, and 14% returns.
So we did the exact same returns.
Yeah.
So this is basically saying we want the same returns for Home Depot and Lowe's.
Very
Mo,
similar numbers across, too.
Lowe's is at 215. Here are my prices. A low of 110 to 132, a high of 185 to 212, a middle of around 150 to 170. If you paid today's price for the company and the low returns happened, the low expectations happened, you'd make about 3.4% on a net present value basis. The middle ones happened, 8.7%. If the high ones hit, based on today's price, you'd make 13.8%. Okay. Well, what's yours?
So I'm 166 to 199 on the low end, 245 to 271 on the high end, middle ground, 200 to 230. And you can see the current price returns there as well.
So we're ways away on both of these.
It's on my watch list at 225, and it's on my watch list at 225 to sell puts at lower prices. I don't want it at 225.
It's on my watch list here at 170. Again, like yours, to sell puts. I don't want it at 170, but I'll start selling puts at that.
Right.